In fact, Rajeev Thakkar, who's a CIO at PPFAS Mutual Fund, joins us in our studios to discuss more. Rajeev, it's great to have you on the show. Thanks very much. Good morning to you. What have you been doing in the market environment currently?
We've started to deploy. So given that we were sitting on cash for maybe 15 months or longer, and we have been cautious on the valuation front, given the sharp sell-off we have seen in the broader market and even in some of the heavyweights, pockets of value have started emerging. It's not cheap across the board, but we have started to deploy, and we hope to be deploying in the coming months.
You're not worried about how there might be perhaps more downside risk to this market versus upside?
So that fear is always there.
But more so now.
So if we were to rewind some time back, so today people are talking about the Italian budget, some time back people would be talking about the Greek budget or Brexit, or some reason or the other would always be there. So one has to remember, let's say things were in reality not as good as they seemed in 2017, and probably things are not as bad as they seem today. One has to keep that balance and equanimity and deploy when valuations come in favor rather than looking at the near term. Sure, I take your point. For a trader, another 10% downside could make all the difference. But if we are investing for 3 or 5 years out, then one can never catch the bottom, and one can keep deploying at various levels.
Your highest region-wise allocation after India is to US stocks, and two big names in there, Facebook and Alphabet, both in your fund holding. I want to talk about Google first, or rather Alphabet. Sure. Actually. Good numbers there. Are there any concerns emerging? Do you believe that if FANG stocks were to correct, which we've seen some volatility already kick in the last 10 days or so, that's bound to impact your fund performance as well?
Sure. So any sharp sell-off can quotationally impact the stock prices and bring down the NAV. So that's a fair point. In the FANG names, the trouble is that we have a uniform acronym for all these companies. Now in FANG names you have names like Netflix, which do not earn much, where there's only promise of the future, or Amazon, which is actually reinvesting a lot of their profits into newer ventures, so bottom line is not much. So in my view, the riskiness is more in that space. Companies like Apple, Facebook, Google, these are cash generating machines. So sure, on a sentiment basis they can sell off, but the earning power is there in these companies. And again, given the shift towards media consumption on digital devices, and given the high role of technology in our day-to-day lives, these are well positioned to capture that shift.
But what is giving you conviction about Facebook? I buy your point about Alphabet, but when it comes to Facebook, with all this talk about data breach, etc., data security, etc., and reports saying that while Facebook's businesses are down, I was just reading an article the other day saying so many teenagers in the US are now getting off Facebook, but they're still on Instagram. Again, Instagram advertising is still very restricted in that sense. So do you think that Instagram could be what Facebook was 2 years back? Because that's the revenue generator.
Sure. So risks are there in terms of privacy concerns, antitrust concerns, and all of these are very, very large companies continuously under the radar of consumers, of media, of regulators and watchdogs. And again, Europe typically looks down upon these businesses which are typically from America, so periodically there are these fines which come in. So sure, those are risks. Let's look at the flip side. They reach about 250 crore people. There's hardly any platform which can give you that kind of reach if you are an advertiser. And this reach is not a generic reach. This reach is targeted reach. So you can target your audience in terms of education levels, age, gender, place of work, place of residence, time of day, all those kind of things, past interests. So that is a very powerful tool for advertisers. And Facebook as a platform has seen slowing down of growth. Instagram has been growing in popularity. WhatsApp again is their platform. And if you look at some of the Chinese equivalents of these businesses, they've gotten into various adjacent areas like payments and things like that, or gifting,
So has
shopping.
WhatsApp, yeah.
So WhatsApp is also getting into that. So there are a lot of properties which are unmonetized as of now, which could have potential
So
down
you
the road.
haven't trimmed your exposure at all to any of the global
No,
stocks?
we haven't.
How are you adjusting your portfolio to a rising interest rate environment?
That's a very key point, I think, going forward. I think that's the main factor where valuations had gone up very significantly in a zero interest rate environment. So what we are trying to do is we are not anchoring on last 1 or 2 years valuation saying prices are down 20%, let's go and buy it. One has to look at 10-year, 15-year averages for valuation. So consumption theme, for example, in India, despite the steep falls that we have seen, those are still overvalued in my view. Again, some of the financial stocks, price to book, price to earnings may not be relevant metrics to measure those because the entire business models were built on access to cheap money. Now, if that cheap money goes away, growth could get impacted, margins could get impacted. So we are wary of interest rate sensitives. We are positioning towards companies which would benefit from a rising rate cycle or a tighter liquidity, and mindful of the valuations that we pay.
But wouldn't you think that that would make you a bit cautious at a time when higher rates could lead to more volatility in the market? So, you know, I come back to the point that you were making about wanting to keep your, deploying cash at the current level because
Sure.
you think that, there could be an opportunity for an upside, but wouldn't that get capped in a rising interest rate environment? So that extent, wouldn't you want to measure your portfolio, like keep it balanced?
Sure. So every environment will have its winners and losers. So when I say that some companies could actually benefit from a tighter liquidity or rising rate scenario, banks which have good CASA, they are not going to jack up the rates on savings account, current account.
True.
And where liquidity is tight, where interest rates are higher, their margins could go up. Again, they could see market share coming back to some of them, what NBFCs had taken away. Also, we are seeing the news of some of the large troubled NPAs getting resolved, or there being a bidding war for some of these steel assets. So gradually, I think the environment is turning positive for some of the CASA-rich corporate banks. So
I know that ICICI and Axis Bank's CASA ratio is also picking up.
Yes.
Does that make them more attractive from a...
We have small positions in these banks, but broadly I think corporate banks will see somewhat better times as compared to NBFCs with asset liability mismatches or with over-reliance on money market.
You have a 3.5% allocation to persistent. Sure. What did you make of the numbers and the management commentary thereof? Are you convinced that this is just a one-off quarter and from next quarter you're going to see better improved margins? Because, with IT, I guess the thing is when the going is so good, then how can they not deliver?
Sure. So these guys have been in a somewhat lumpy business. Their business moves project to project, and I guess management is disappointed with the trajectory, and we have also been somewhat disappointed in terms of growth has been below expectation. However, their focus has been razor sharp on the newer areas of IT spend, which is the mobile apps, analytics, cloud, artificial intelligence and machine learning, those kind of things, where the incremental IT spend is moving to, and they have been leading the recruiting the right people and training people in the right skill sets. So it may take a while longer. We are invested in that company. Obviously, the
You're
markets,
willing to be patient and wait it out still?
Yes.
Any other new names on your radar?
So our fact sheet will come out, but we have added just one stock in the in the current environment. Most of the additions have been otherwise in the existing positions.
And what sector is it in?
Automobiles.
Okay. Just one final word on how do you map the next 6 months for the markets, given politics?
I think politics is always a worry before the elections, and typically no one gets it right. So people in the investment management space have gotten it consistently wrong last 3 general elections, and that has resulted in either upward circuits or downward circuits. But 3 months, 6 months out after the elections, people forget and no one cares about it. In fact, Saurabh Mukherjee had a very interesting point. He says most of the reforms actually in the past 2 decades have come by minority governments, where the coalition was such that people had zero expectations from those kind of governments. So I think medium to long term, it doesn't matter. People move on.
People move on. Rajeev, great speaking with you, and a pleasure having you in our studios.
Thank you. Pleasure.
Thank you very much.